Good morning, good afternoon, good evening. Welcome back for another video. In today's video, I want to talk about Bitcoin and the crypto markets in relation to the CPI. If you like this content, smash up that like button, subscribe to the channel, leave a comment in the comment section. But otherwise, let's go ahead and dive right on into it. So, hey, green day on the markets, good to see. And, you guys, I have been saying for so long, I am a buyer in the 30s. I do not see a compelling reason for Bitcoin to go down to the 20s aside from some kind of major black swan event, and I'm sticking to that until being proven wrong. And I mean, the longer we go, the less likely it is that's going to happen. The 200-week simple moving average is rising every day. It's now at $21,000. That has marked a bear market bottom, and I believe we're not going to touch that for a decent amount of time. And then there's so many other things you've said. If you watch my channel, you know where I stand on things. And so looking at Bitcoin today, it's a good day. But I mean, honestly, still we're at $41,200 as I'm saying this. Until we even get anywhere close to the bull market support band, I am bearish in general. Above the bull market support band in general, I'm bullish on cryptos. Below it, I'm bearish. What caused us to go below the bull market support band? I was hoping that we were going to hold, but and I'm going to get to this trend line here in a minute, but I want to talk about this first. Last week, Governor Brainard said essentially the Fed's balance sheet runoff will be rapid. I mentioned this in a previous video. I talked about it in my live stream last Friday, but Governor Brainard the fact that she in particular said it does carry some significance. So I've done a little bit of research on Governor Brainard, and what I've found is that she is the most notoriously dovish governor on the board of governors in the Federal Reserves. And so for her to come out with a statement like that, the markets are going to pay attention to that. And so the stock market, the crypto markets took a dump pretty hard and broke through those levels. I really think that if it wasn't for the increased anticipation of hawkishness on the Federal Reserve's part, that we would have just kind of bounced between these levels, the bull market support band, the 200-day simple moving average, and then eventually broken through. But the amount of fear that increased hawkishness brought into the system brought us right back down below the bull market support band. But now I've been seeing this before, and I'm wondering about it now. I've been seeing this. I drew this trend line today. I've seen other people do it, but I noticed this around here. When was this? Mid-March, right? I noticed that, hey, it does look like we have a trend line that could be forming here. And I would say that the last few days are confirmation about that. And so my general rule until something is broken is that next time I see Bitcoin kind of bounce off of this line right here around this line, I am going to long. And when I see it rise up to the bottom of the bull market support band, I'm going to short. Now, of course, if Bitcoin breaks through to the upside of the bull market support band, the levels will change. The short will be the 200-day simple moving average. The long will be either the top or the bottom of the bull market support band. But for now, this is kind of my playing field. I always want to draw some playing fields, at least when it comes to trading, all right, I'm long here. I'm long on the trend line. I am short at the bottom of the bull market support band. And so we have this new trend line, and that is my rule for now. It's nice to be confined within a space, and this I can see a very compelling reason to believe why this should be the space that we should be confined to at the moment. And other crypto plays, that's how I would function right now. There's more room to the upside than there is to the downside, so that's a good sign that we could go higher. But otherwise, we'll see. So the other thing I want to talk about, consumer price index. So CPI came out yesterday, and there was a pivot. There was a pivot in the markets yesterday. It looked like we were going to dump through that, and we did have a wick below the trend line. But then we've kind of reversed. We had a green candle yesterday. Yesterday morning at 8:30 a.m. Eastern Standard Time, the CPI numbers were released. It was a score of 8.5. Expectations were 8.4. Not the end of the world. I've basically said that I expect CPI numbers to rise over the next couple of months and then peak in maybe May or June and then start its way down. And honestly, I mean, I really don't see a reason to be bullish while the CPI numbers are rising. I see a reason to be bullish when they're going back down because of just extraordinary actions that the Federal Reserve or the federal government can take in the face of these rising CPI numbers. I don't know what they're thinking, but they see it going higher and higher every month, and they're probably reacting a little too strongly, or there's the temptation to react a little too strongly as they see these CPI numbers rise. And so what does that mean? Quantitative tightening, that means more aggressive interest rate raises could be on the table. But there's something that interesting that I've seen. I've seen this fractal before, and this is sort of my case for why I do think that we're going to peak soon. Here is a fractal from the beginning, January of 1972. It starts here, and this is for us January of 2020. You know, we saw those rates dump, or not CPI numbers. We saw the CPI numbers dump, which is generally what happens in a recession. Is that interest rates will dump, and we might then there's the threat of deflation, and so the threat is that the Fed is going to turn heavily dovish at that point, and that happened in March of 2020. We saw all the stimulus, we saw lots of things going on. We saw interest rates just go straight down to zero, and then actually I do have a image of that. So you can see that here, a peak in 2018, 2019, mid 2019, and then February of 2020, rates were at 1.5%, and then boom, all the way down to zero. And so that's what happens. That's what's going to happen every time there's a recession, I believe. But back to this chart, I mean, here we're in about the summer of 1974, and as we're following along this trend, I do believe that it's going to be similar, where we'll peak. I don't think we're going to cross 10%. I think that we'll peak a little bit under 10% around here, and then naturally, without any intervention from the Federal Reserve, the interest rates would continue to drop. This is my expectation. I took this from Ecoinometrics on Twitter, and I believe that that's going to happen. I don't believe that there is a compelling reason to expect it to go all that much higher, especially considering when we're talking about CPI, this is a year-over-year thing. And so here's another thing that I've been looking at. So when did the CPI numbers start to rise? Well, we see March of 2021. So March of 2020, COVID crash. About a year later, we started seeing the effects of all the stimulus, of all the quantitative easing, of the interest rates going down to zero. We started seeing that effect in 2.6. March of 2021, and then we kept on rising. So 8.5, that's an increase of 8.5 over this already previously rising level of interest, what am I thinking? Not interest rates, inflation. Inflation. So now we're combating against last year, where last year it rose by 1.6%. And so if we saw a score of 8.5, that is 8.5 plus a rise of 1.6%. That it gets to a point where that's going to be pretty difficult to maintain. Another reason why I think we're going to peak somewhere around here, May, June. So, I mean, all right, in May, we'll get the April CPI numbers. In June, we'll get the May CPI numbers. So maybe we'll peak in July. I don't know, but I think we're close to a peak for that. And then we can kind of unclench. And who knows, maybe that's what's going to lead to some kind of a rally. I've heard, and I do expect that, at least when it comes to the stock markets, that we do have one more push higher. And I am very much expecting a recession. And I want to be clear about that. I'm going to exit pretty hard at some point, but I don't think we're near that yet. I think that's coming sometime in 2023, and that's going to be when we hit the bear market bottom. So whatever happens before then, I mean, I don't know, six-figure Bitcoin or altcoin season, whatever else, I do think that the stock market has one more leg up, and that crypto will correlate with it. And whenever I see the Fed start to turn dovish, like they did in these previous times. I want to make a separate video about this, but when the Fed starts turning dovish, it is a sign that they sense a recession is coming. And so here's what I'm expecting. I'm expecting another rise like this, but maybe I think quicker than this. You know, that's over a 2-year period where interest rates rose pretty quickly. I'm expecting a quicker rise, and then as soon as they flip, that's going to be a sign that stocks will still go pretty high as when they flip. I think that actually will be a catalyst for stocks and cryptos to go higher. But as soon as they start turning dovish again, I'm going to very much be taking some off the table. And I'd recommend a similar strategy because they sniff out a recession pretty well. I don't think they're able to sniff out the effects of 0% interest rates or what else of the effects of all the money being injected into the system. I think that they can sniff out a recession pretty well, though. I will give them credit for that. So that is what I'm paying attention to. And if you're confused about that, again, I will be making a separate video at another time. But until then, that is about all I have for today. So I hope you have a wonderful rest of your day, a great week, and I will most certainly be seeing you in another video. All right. Peace.